Hi everyone, and welcome to this week's webinar from Hantec Markets. This is me, Richard Perry, Market Analyst here. This one is called Discovering Multiple Chart Patterns, Multiple Period Chart Patterns. A bit of a mouthful, I know, sorry about that. But yes, this is where I will take you through one of the more fun elements, I suppose you could call it, of technical analysis, whereby you have the identification of charting patterns. You've probably heard a number of patterns over the years: head and shoulders, double tops, triangles, flags. We're going to try and get through as many of them as possible today in the time that I'm allowed here. But just because we're going to be talking about live market activity, I will be just showing the disclaimer. First of all, the disclaimer which I will also show at the end of the presentation. Yeah, it's just advisable that you just have a quick read through that in case you haven't done so already. As usual, that's my biography, so we'll quickly gloss over that, fortunately. And straight into the agenda, which we'll start with a few pattern theory tips, and basically then we're going to go on to, I'm going to talk about a few ideas that I think that you should utilize in your pattern theory. One is that you should trade what you can see, and also the second one being watch for the pullback in the market, which happens an awful lot. So that is one thing I would say is advisable. So we're going to look at some reversal patterns and continuation patterns. They are the two main pattern topics that we will cover, and within that you've got reversal patterns, head and shoulders patterns, and then double tops and double bottoms, and multiple tops and bottoms, and then into continuation patterns we cover triangles, flags, wedges, and range breaks for your continuation patterns. So after that, well, I'll be taking you through a few live examples of that in these markets. But crikey, what's going on there? But then we're going to cover just a bit of live analysis of the market. So we will cover that towards the end. I'll just take you through some of the key FX markets, gold, some of the indices, and see what is going on as we speak. Okay, so we're going to start off with pattern theory. As I said, there's two different types of patterns: reversal patterns and continuation patterns. Now, technical analysis basically is the it sort of involves charts depicting support and resistance, and basically we covered Dow theory in trend lines, and basically when trend lines get broken or start to break down, you start to see a change of opinion, basically, and that is when you start to see when these trend lines and supports and resistances start to get broken, you start to see patterns emerging. And it's basically with I suppose experience, really, but there are a recognizable series of patterns that can often occur in technical analysis that then will give you an idea of exactly where the market will be heading next, and also gives you a nice target as well that you can work towards. But as I will reveal later on, the targets are not always set in stone, but certainly they give a very good indication of where you should be seeing your move that you're going to be trading to. The first thing also I would say is that pattern formation is not it's not a science, it's an art, and for that reason you will find a lot of traders seeing different patterns, because it's a lot of the time traders will go on what they can see, and obviously beauty is in the eye of the beholder. Sometimes they see things that other people will not, and hence that's what makes a market a lot of the time. So that is one of the things that I will say to you is my advice in that instance is to trade what you can see, and if it doesn't basically growing up, in my experience as an analyst and in my formative years, the guy that I learned from, who was very high up in the STA, which is the Society of Technical Analysts here in the UK, he basically told me to never trade unless it basically hits you between the eyes. It's not really a viable pattern, because that is how you start to get into trades that you're not necessarily comfortable with, because you start to question yourself, because the pattern is not as significant and as viable as perhaps it should be. So always trade on what you can see is basically what I am trying to get over to you. Good thing about pattern analysis also is that you can do it across all manner of time frames, from the 1 minute chart, 5 minute chart, up to hourly, daily, weekly, and even monthly. There are patterns that emerge that you can trade on. So certainly, depending on your time horizon, you can use pattern analysis across all those timescales. So that is a good thing for what we are about to speak about. Okay, so we're going to start off with reversal patterns. Now, you can see on this slide that I've got here that reversal patterns are as what they say. Basically, it's where you see a prevailing trend, and then there is a trend reversal, and ultimately the pattern is the reversal process of that trend, where you start to form a new trend in the opposite direction. And then continuation patterns are effectively consolidation patterns, and they just happen mid-trend, and they just basically are stopovers before you see the trend moving in the direction of the prevailing trend. So it's they are continuation patterns. Right. First of all, head and shoulders. You get head and shoulders tops and bottoms. As you can see here with the head and shoulders top, you have this prevailing uptrend that starts to break down. You see the uptrend broken. You see the support coming in around the old key low, and then the reaction to that forms a lower high, and that lower high is formation of the right hand shoulder, and then ultimately the bulls start to lose impetus and the selling pressure grows, and that is then broken to the downside of that support, which is the neckline, and then you start to see the new trend forming in the opposite direction. The opposite of that is the head and shoulders bottom, or inverted head and shoulders. That comes at the bottom of a downtrend, and that is again where a downtrend is broken. You start to see a challenge of the resistance. The resistance remains intact, but then you see a higher low formation of the right hand shoulder, and then subsequently that rally then starts to push higher and breaks through the neckline resistance to complete the pattern. Now, in both head and shoulders patterns, the target of that breakdown is measured from the head to the neckline and then projected downwards in the case of the top, and head from the head to the neckline and then projected upwards in case of the bottom, or inverted head and shoulders. The next pattern is double tops and bottoms. Now, just very quickly, I'm going to go through these as quickly as I can in terms of the theory, and then I'm going to show you on the chart, so just bear with me in terms of that. This is double tops, where you've got the uptrend in place, that continues to go, but then you find that you don't break to a new high. Now, that is classic Dow theory, as we looked at in trend analysis, where Dow theory says that you get higher highs and higher lows in an uptrend. Well, you don't subsequently get another higher high in that uptrend, and then you start to fall over. You break through the uptrend, and then you see a break of the reaction low, and then that completes your double top formation. Now, the second top generally should be coming at or just below the resistance of the first high, so just keep that in mind as well. Similar story for the double bottom, where it's the opposite of that, where you're in a downtrend, you then see a breach of that downtrend followed by a break of the reaction high to form your double bottom. And again, as with head and shoulders patterns, again you see the pattern implied target is the height of the top, which is from the top to the neckline measured downwards in the case of the double top, and then the depth of the bottom measured from the trough to the neckline and then projected higher for the double bottom. It's probably a good idea at this stage to start to think about different concepts of reversal patterns. Now, basically, the first thing is, which I covered in the PDF that I'm hoping that you've all had a chance to read, is that you shouldn't really get too bogged down in what you're going to call your top or your reversal pattern, because okay, sorry, I've just seen that should say reversal patterns, my fault. Anyway, you don't get too bogged down in what you actually call your top or your bottom, because ultimately as I said earlier, we're looking at Dow theory, and that is more what you should be interested in, is the fact that we're seeing a trend reversal and ultimately the start of a new trend in your reversal patterns. And basically, because of that, that is the most important factor you need to be looking at, not whether you call it a double top, a triple top, multiple top, a head and shoulders top. It doesn't really matter, because as you may have noticed when I pointed out the projection of the target, it's actually just the from the top down to the neckline and then projected once more. So if you actually look at that across the tops and the bottoms, it doesn't overly matter what you really call it. It's just for your, I suppose, peace of mind, rather than the actual price action involved, which is what we're all interested in ultimately. So the second one is about the fact that you should be trading, be careful for the pullback. Now, the pullback rally, you can actually see this on this double top chart that I've got here, where you've seen the breakdown of the pattern, and then you see a quick retest of the resistance. Now, what you will often find, as I said, because of a concept that we talked about in support and resistance, is that old support becomes new resistance. In the case of top patterns, this is the support, the neckline support. Once it's broken, that becomes a resistance, and what you will find often, and I say often because it does happen a lot, is that you then start to get a retest of that neckline resistance, and being resistance, it's where the sellers who bought up around this point here, who saw the gains, and then all their gains wiped out into a loss, and then they see basically back towards flat again. They see that as another opportunity to sell again, and then the resistance comes in, and then the price falls away again. So you need to bear that in mind if you're going to be trading these reversal patterns. Bear in mind that pullback, that is, in the case of a top pattern, a pullback rally is a very interesting and useful trading tool to remember, because you do that a lot, and that gives you a second chance to ultimately go short if you're trading your double top pattern. The other factor I want to just talk about quickly is you need to also bear in mind how your macro trends are looking, because you might be trading a double top short that might be coming in a primary uptrend, and because this is in a primary uptrend, you will often find shorting into an uptrend, which is at the best of times it can be risky, but you will often find that your downside targets are quite often not met, because the bulls are ultimately in control of the whole trend. Although you might have a near-term correction within that trend, which is what you're trading, the implied downside target may not be met before the bulls start to gain control again, and then start to buy in that uptrend, in that primary uptrend. So often you will find, as I said, if you're trading against the macro trend, then you'll find your targets that are not met. Similarly, if you're trading with the trend, with the macro trend, say for example you're doing a you're buying or say for example you're selling a double top pattern into a big downtrend, into a macro primary downtrend, then you'll find your downside targets will be more than met, and some more as well, because the prevailing trend, the big driving trend of that market is to the downside. So you'll see that your targets are often met and beyond. So just keep that in mind when you're trading. Right. Okay. Now we're going to look at just one more thing. Looking for confirmation. When do you actually trade on a breakdown or a breakout? I like to trade confirmation. And confirmation, in my opinion, comes in a series of ways. There are two ways, in my opinion. You either trade at the resistance of the pullback, which we've already talked about, and that pullback rally, just once it starts to fall over again, that gives you the confirmation, in my opinion, that top pattern is in place. Or a second confirmation could be that it continues to fall away and breaches another key support within that old uptrend. So there are two ways, I think, that you can look for confirmation of your patterns. Right. Continuation patterns. We're going to look first of all at triangles. Triangles are basically in three different types. You've got ascending, you've got descending, and symmetrical. Now, your ascending triangle is a bullish pattern. Is where you find the price bumping its head against a resistance level, and then every time it falls away, it starts to find support at a higher level, hence building you a triangle, and then you ultimately break to the upside. And then what you do is, in terms of the measurement of that, you can measure the height of the triangle, and then project that from the breakout level. Is certainly one way of doing it. Descending triangle is the opposite of an ascending triangle, surprisingly. It's a bearish chart pattern that comes in a downtrend. Again, these are continuation patterns, so descending triangle is in a downtrend. Again, it's just a consolidation at a support that then subsequently finds resistance at lower levels to form that triangle pattern, and then ultimately breaks to the downside. And again, once again, you measure that through the height of the triangle measured downwards. Okay, third triangle, which I'm not 100% happy about trading, because I think it's not a true triangle in my opinion, is a symmetrical triangle, because the whole fact of triangles is that they should be continuation patterns, and ultimately a symmetrical triangle could break both ways. Because you've got higher highs and higher lows, and ultimately you don't know which way that's going to break down. Now, you could argue that coming into the triangle, if you're in an uptrend, then the pattern breakout should be to the upside. However, it's not always a given, and it could also equally be to the downside. And as you can see here, you can have two targets of these patterns, but I'm not a massive fan of symmetrical triangles, and I would be rather skeptical about trading them. Okay, so flag patterns. These are short-term trading patterns. Effectively, I see flag patterns as a halfway house, and they're more of a consolidation pattern. And then what you do, they come after the breakout of a sharp move to the upside. You then see a consolidation, and then ultimately that consolidation starts to break once more to the upside. And on that break of the lower high, that is the point at which you start to do your implied target. You take your pattern breakout, and you can trade it. Similarly, a bear flag. So you've got bull flags and bear flags. Bull flags are, as I said, in a continuation pattern of a move higher, whereas a bear flag is a continuation pattern of a move lower. Right, quickly on to wedges. Wedges I see as longer term flag patterns, you will often see wedges happen over the course of several periods, whereas flags are often over just a few quite often. So you tend to find wedges are more longer term patterns. But they are very similar concept to flags. Basically, you've got a sharp move to the upside that then sees a consolidation. This is a bull flag, which is a falling wedge. Sorry, bullish falling wedge. So you have a sharp move to the upside, consolidation, and then again a sharp breakout to the upside again. Bearish rising wedge is a similar sort of story as your bear flag, where you have a sharp move to the downside, see a consolidation, and then bang again to the downside. Okay, so that leads us on to finally continuation patterns. Again, this is a consolidation pattern where you see a move to the upside. This is a bullish range breakup. A move to the upside that then sees a consolidation between support and resistance at similar levels. Generally speaking, it should be testing, theoretically speaking, it should be testing the resistance and support both 3 times before breaking higher. But then on the upside break, you then measure the height of the range and then project that higher to give you your target. By the way, I'll go through all these targets again when we've got the actual charts up for you. So the opposite of that comes in a downtrend, consolidation pattern, and a range break to the downside as a bearish range. Again, you have this consolidation in between support and resistance 3 times supposedly being tested on each support and resistance before you get the downside break, and you measure once more the height of the consolidation range projected down. Okay, so I'm going to quickly now show you some charts. Right. I've got a few charts to show you, so I'll try and be as quickly as possible. This is cable. Basically, I've got an example of all the charts that we've got here, and this is cable on a weekly chart, actually, between 2006 and 2008. So almost 2.5 years worth of pattern going on here. This is a big head and shoulders top pattern. You see the move to the upside. You then see one shoulder is to move back down to test that support once again, which doesn't break down. You then see a right hand shoulder, and the support of this neckline ultimately retested again, and then on that breakdown there below that support, you've seen a close below that. You will notice how sometimes you can have very slightly sloping trend necklines. Just be careful not to have them sloping too much, because that sort of detracts, I believe, away certainly from the quality of the pattern. Again, we're looking for the pattern hitting you between the eyes, really, and when you have significantly sloping trend lines, then often significantly sloping necklines, you will often not really have the clarity of the pattern there. But yes, on this head and shoulders top pattern, you had the breakdown, and then you can measure from the peak to the neckline, and then project it downwards from the breakdown point, which gave us in this instance $1.76. You didn't really get a pullback in this head and shoulders, but this is on a weekly chart, so maybe you probably could have got one on the daily chart, but certainly on the weekly that was what we saw. Okay, head and shoulders reversal, or inverse head and shoulders bottom, whatever you want to call it. This is sterling yen, and this is on a daily chart. Between 2008 and 2009, a few months this pattern took, but we saw again the formation of this pattern. That resistance coming around these old lows, which was interesting, and then started to build. You had the head, and then a test of that resistance again fell over. you then got a smaller head, smaller shoulder, sorry, and then the breakout. Now, you've had several pullbacks here. Now, this pullback again came actually beyond the neckline, but you will find, certainly the textbooks will tell you that a head and shoulders pattern is not aborted until the right hand shoulder is breached. So in this instance, that right hand shoulder remained intact as a support, because if you think about it, it's the whole concept of forming higher lows, and once again Dow theory, so you want to be forming higher lows in these inverted head and shoulders. And this is what we got here. This is the pullback. You might have been a little bit wary of trading it in that instance because you've gone back below the neckline, but you then start to pull higher again, and breaking out higher. This gives you yet another chance to get in back towards the neckline support, and then again you start to push higher. Now, as I said, we are that was the target. Let's see, I can't remember if it actually got to the target ultimately. No, no it didn't, but it's not far off getting to the target. It's not far off at all, so I think that is a fair one on that side anyway. Okay, we're going to look at the euro on a double top. Now, this is actually quite a recent pattern that we are still seeing playing out. 136.70 is anyone who follows me on my daily videos and daily analysis will hear me talk a lot about 136.70, because that is the big resistance area on euro dollar. That was the formation of the double top pattern, the big double top pattern that has been in place for several months through this year. Retested on a rally high. That was after the ECB meeting. Retested again before falling over, and looks like once more, although I will go into a bit more detail with the euro, towards the end when we look at all the charts once more in more detail. It's getting a rally back towards this neckline. Again, I would see this as another selling opportunity. I don't see anything really else to suggest that it isn't going to be another selling opportunity. That target from the big double top pattern on euro dollar is 133.75. And as I said, once again, we've had a couple of pullbacks, but I still see that this is going to be a chance to sell euro. Okay, another double bottom on sterling very quickly. This is on an hourly chart, just showing you an intraday basis that you had the resistance. This is back in early June, and you had this double bottom pattern play out, breach the upside. You got this pullback here, and again here. Although you've slightly moved below that neckline, you still ultimately get the sharp move to the upside towards the implied target. Okay, here's another double bottom on sterling once again. So it seems to be quite often. Anyway, interesting. Once again, if you look at this chart, this I would class that as probably a double bottom. But to be honest, it could be a head and shoulder reversal as well, or an inverted head and shoulders, because there are several elements to the base pattern which test that neckline resistance. You could argue that is a left-hand shoulder. That's the head which makes a new low, and then your right-hand shoulder. So you could even call this a head and shoulders reversal, inverted head and shoulders. The point I was trying to make earlier is it doesn't really matter. The fact is that you've got this base pattern in place. You then start to build these higher lows. You move to the upside. You see this breakout here, and you get a pullback right back to the neckline. Interesting, because it gives you yet another chance to get in this trade on an hourly basis. And you're in, and you've got 64.30, and it's hit nice and easily in the subsequent days afterwards. So that is a very good instance of a base pattern working with a pullback on cable. Okie dokie. This is a rounding bottom, but again, I mean, I mean, I called it a rounding bottom because I really struggled to find rounding tops and bottoms in the currency markets. However, you would argue that it's almost a multiple low bottom in place, but again, it doesn't really matter. You basically see the entry into the pattern where you see the sell-off culminating in moves that ultimately see higher lows in place, a neckline. That neckline is breached. Once again, you see chances to get back into this trade, pull back to the neckline, and then a move ultimately towards the target, which is 36.50, and that ultimately found support numerous times on that neckline before pushing higher. This is actually back from June, so not too long ago at all. So a pretty good pattern there on the euro. Okay, euro sterling. Okay, we're going to move on to triangles now. This is a descending triangle where you've got the downtrend into the triangle where you start to form support, and then you get these instances of reactions that peak out at lower levels along the way before a sharp move to the downside. You've actually completed the pattern, the triangle breakdown here, and it's actually given you more time to actually get back into the chart. But ultimately, that second sharp move to the downside gives you an extra opportunity and hit the target pretty much bang on, and then subsequently formed support around that target, which was interesting in itself. So, and in fact, you could probably form some sort of base pattern from that analysis. If I put my crosshair, yeah, you could argue that that's some sort of a base pattern. Again, how do you define that as a base pattern? Well, my definition of a base pattern is with Dow theory, in the fact that you see a downtrend in place, subsequent support that breaks that downtrend, and then subsequently you start to form higher lows and then pushing higher. So that is why there could be a base pattern there. Okie dokie. Ascending triangle. Now, I did struggle to find an ascending triangle. However, this is Footsie over coming up to a 16-18 month period. Is that an ascending triangle on Footsie? Well, you're hitting it. Footsie is hitting its head on this resistance around that 68.90 level. 68.95 was the ultimate peak, which is the 14-year high. But you've got numerous higher lows in throughout this triangle. So you'd be asking, is this just one big enormous ascending triangle? Could be. Certainly you need Footsie to form support around this uptrend, which links all the higher lows, and then you'd probably be looking for a breakout around about the next time it tried it. But yeah, so that is possibly going to give us a nice big upside target if you did ultimately get that, and you'd get your upside target from measuring that higher, 7,600. Wow, if it did happen. So it hasn't happened yet, I will stress, but that is exactly where you'd be sort of ballpark figure you'd be looking at on Footsie. Is there a triangle on gold? Well, there was, yes, in April and May. A symmetrical triangle. So what you think about symmetrical triangles. I'm not a big fan of them, but there was a breakdown that didn't actually ultimately find the implied target, because your implied target on the symmetrical triangle, as I said, is the height of the triangle. It gets measured from, to be honest, the conservative way of measuring it is from the upper trend, and then the bullish, or the what's the aggressive way of trending, getting the implied target is from the lower trend, but that is how you get your trend on that symmetrical, how you get your target on gold from that symmetrical triangle. So you measure that height effectively of the triangle and then project it down. Aussie dollar. Now this is a bull flag. 1st of July, this is on the hourly Aussie dollar. And we had a nice bull flag, had a strong move to the upside, as you can see there with your flagpole, and then you ultimately then measure it from, again, you can either go conservative or aggressive with your targets. Conservative target is to measure it from the low of that breakup. So you basically measure it from the key low. So you measure it. You've got the flagpole, consolidation, and then you measure the flagpole again from that low once you've broken higher, and that gave you a nice target, which was reached pretty quickly. Was the aggressive target reached? Oh, pretty much, yeah. It was exactly breached, to be honest. So both the aggressive and the conservative target were met on this bull flag of Aussie dollar. So that is a pretty good instance of a bull flag there that you could have traded. I'm going to go 5 minute here. This is interesting. Now, I've written bearish flag, but you could arguably call it a wedge because it does go on for quite a long while in terms of the periods across this 5 minute chart. But to be honest, as I said, wedges and flags are very similar in terms of their targets. And once again, we get our downside target, which is measured. This is very rough as I'm doing it, not a straight line. And you measure that from the break higher target. So you have your sharp move to the downside, consolidation, where you just start to drift higher and then bang, and the bulls run out of buying impetus and you get a sharp move back to the downside. And this target on euro dollar was met within a matter of minutes, so you'd have had to have been very closely trading on this one. But still, one tip I would give you on flags is they do tend to work very well on short-term charts. I have noticed in my trading of Forex, I have noticed that trading on the 1 minute charts and the 5 minute charts on some of these Forex, when they do start to go in one direction, you will get a consolidation which will turn out into a flag or a wedge, depending on how you want to call it, before moving once again in that same direction. And that has caught me out on a couple of occasions where I've thought that was the limit of the move, and then I thought it was going to start to retrace, and then bang, it's gone again. And when it goes, it does go very quickly. So you've got to just stick very close to it if you're looking to trade it. So another bearish rising wedge that is on Footsie, this time on the daily chart. This is from 2012. Not the best instance of a sharp move into it, but certainly I think that it does turn into a wedge, and then you get that sharp move back to the downside once you're breaking that trend. So it is a fairly reasonable bearish rising wedge there on the Footsie. And I'm going to finish with a couple of consolidation ranges. This is euro dollar, January 2013. You had this these gains in euro throughout late 2012 that you saw a sharp move into the upside, and then you saw several peak highs and lows which formed a nice consolidation pattern, which ultimately, when you saw on the breakup, you then got a pullback, which gave you a very nice opportunity to get back in again, and then once again you measured to get the pattern target. You measure the height of that range and project it higher. And that is how you do it. If you want to get exact, which is how I did it, you basically just do the calculations on the numbers rather than actual height of the pattern. Although if you were doing this with a pencil on a piece of paper, you would probably do the height of the pattern. But I like to use the calculation. So in that instance, I would have done 34.03 down to 32.56, which is not far off 150 pips. So ultimately, yes, that is measured higher from there, around about 150 pips would have been your target. Okay, one more range. This is hourly Footsie. This is from April, and again you've got this nice move into the pattern, sharp move in. It sort of then consolidates, highs and lows, highs and lows, highs and lows, and then once again you see a breakout to the upside, another pullback, which nicely uses the support of the old resistance. Old resistance turns into new support once again on the pullback, and then it starts to go back towards the implied target, and that one worked pretty well. You would have said that nicely hit the target and ultimately kept on going as well because it was a bull pattern. Okay, that is my examples of all these charts. Now I'm going to see how they fit into the current analysis. I'm going to bring in a few extra indicators as well for you and give you a live look at what's going on. This is euro-dollar, and euro-dollar, as I said, has got this big double top pattern that completed below 36.70, which is now where we're looking at for the basis of resistance. That is, I think, where I would be certainly looking to put some sort of shorting opportunity into the market at around that 36.70 mark. In terms of how this pattern is moving here, you could, and I say could, argue that we are seeing the possibility of a head and shoulders, an inverted head and shoulders, or a head and shoulders bottom. Now, if you got a break above 37 big figure, I think then you'd start to certainly consider whether that is breaking down that big double top pattern, because that, you could argue, then is a pretty well formatted or formulated inverted head and shoulders. However, until that happens, and I still don't think it will happen, because you've got all these the moving averages, 55-day moving average capped that recent peak. This, if I zoom out, talked about it on the morning report numerous times, 144-day moving average, moving averages we will talk about next week, by the way, or sorry, in 2 weeks' time. Moving average, the 144-day moving average, has capped the big moves, big corrections in this downtrend, and also capped the recent rally as well. That comes in at 37.05. So you can see around that 37 big figure mark there is going to be some big resistance, I think, and ultimately I think that will contain this rally, and then it will be a selling opportunity around probably 36.70. If you look at the momentum indicators, MACD lines are below zero. That's negative. RSI is reasonably neutral, as is stochastics, but I think just the fact that we've got this big double top pattern in play, I still think that suggests that the overriding trend is negative on euro. Okay, so sterling. Now on sterling, I've drawn in this big, almost a trend channel on sterling. In fact, let's see what happens if you go back there. I haven't done this previously. No, No, not really. Okay, but you would still argue that that old uptrend, in fact, that I've gone back to there, so that's why not. That old uptrend that was broken briefly to the downside in this period here, and then is now using the support again. So you'd still say that the bulls are in control of this. This small consolidation pattern up here, which I'll again zoom in. Small consolidation pattern up here, I think, is going to ultimately be just that. It's not going to be a sharp corrective pattern. I think it's going to be just where the bulls unwind a bit of this overbought momentum. In fact, that's what we're doing at the moment. It's already taken the RSI below 670. Stochastics remain fairly positive. Our MACD line's also looking good. So I think that this is going to be just a consolidation phase before the next bull leg higher in cable. And I don't really see too much wrong with this chart at all. In terms of support and resistance, you would certainly, on a longer term basis, say $1.70 is now a very good support, as is $1.70.60. So there's a nice band of support in there, in which you can put any long positions if you saw a correction back into that. So that is my outlook on cable. Now, the one that I hate more than all of them is dollar yen, because it has basically been doing nothing for months, and I will show you. Come on, that you've got this trading range here. So every time throughout this year, pretty much every time, I'll zoom back through the year, since February, every time dollar yen has got back to 101.30, it's rallied. It hasn't closed below that point, although you've had intraday peaks below. Sort of a look at a breakdown. You haven't actually had a close below that since that kilo, and that was in early Feb. All these retreats towards 101.30 have ultimately seen dollar yen close above 101.30 or at 101.30. So I think that would suggest that that is a pretty big support level on dollar yen. If that starts to break down on a closing basis, I think that could be your signal that dollar yen is going to start to move lower. Other than that, dollar yen is basically moving sideways. Has done since April. You see this 101.30 support coming in, and then the resistance coming in at 102.80. And that's where the resistance comes in, 102.80. Moving averages basically neutral, and moving out and momentum indicators pretty much as neutral as you can get. So other than the being able to talk about that support and resistance, it's pretty much an open book. I mean, I've got no idea, because it just goes. I mean, just goes for a few days on the upside, few days downside, few days upside, downside, consolidation there, but a few days downside, upside, downside, and it's trading at the day high as we speak. So does that mean it's now going to be pulling higher again? More than likely, back towards 102, which in my opinion seems to be a consistent pivot level on dollar yen. So it's horrible to trade. I do not like dollar yen at all at the moment. Just need a breakout of some description to start finding a bit of a trend once again, because it's impossible to trade at the moment, I think, on an intraday basis. Okay, gold. Well. That is gold over the past couple of years, 18 months actually, but almost 2 years. Been in this big downtrend, and you are now testing that downtrend. The big question is it going to break or be confirmed as break? Well, the bulls have had a fairly reasonable go at it today, but you are in this consolidation pattern. Look at the amount of times you've got neutral candlesticks in here. We did candlesticks last week. Neutral candlesticks are where sort of opening and closing around the same point, closing around the middle point of the day, things like that. They're neutral candlesticks, and at the moment it just seems to be very, very neutral in terms of this sideways trading over the past 3 weeks. If you look at your momentum indicators, you could argue that they are beginning to roll over and threaten some sell signals, but we've not really seen any move yet. And as I said, today we've seen a bit of support coming in for gold. But until we break down below 1306 or above 1332, I don't really see how you can really trade gold on an intraday basis, because it's very difficult to really gauge exactly where it's going to go, because you've got so many neutral candles, so much trading around that 1320 mark as well. 1320 seems to be a bit of an equilibrium for gold, and the fact that we're above it now could argue that it's more than likely to retreat back towards 1320 once again. Right, here we go, a bit more interesting. Footsie and DAX. Start with Footsie. Footsie today has really 6,700 is that big support from that June low. Just breached it slightly, 66.92 earlier, but the support has come back in, so you wouldn't say that that support has failed as yet. We're also trading around this primary uptrend here. If I zoom out very quickly, you will see this primary uptrend that has been consistent since Q3 2011. I would say that's a pretty good uptrend. You can, yeah, I mean, it's basically trading on it now. Yes, these two instances where you had slight breakdown would suggest that you've got to be a little bit, give a little bit of leeway on these big primary uptrends, but certainly it would suggest that we're not far off trading around it at the moment, and it needs, I think, to now hold 67 big figure. If it breaks down 6,700, then I think Footsie is in near-term trouble, near to medium-term trouble, because I think that will ultimately end up being, you could argue, a bit of a top pattern. It's not a great one, but I think that would suggest you're probably going to be coming down quite quickly towards this 6,500 mark, which is where all these lows came in from March and April. So just be careful of that. Okay, DAX. Right, similar sort of story really. You've got this top pattern, arguably, or consolidation pattern that's really been tested, not quite completed. I will zoom in. Not quite completed on the breakdown. However, you've pulled back below this 9,810 point, which was a key breakout level, and that's not massively encouraging. You've also broken this 4-month uptrend, this sharper uptrend that had supported in June has been broken as well. This moving average here, which is 21 days, which has basically been rising since late March, has now turned lower, which is not a great indicator either. So yeah, it's under a bit of pressure near term, but I think ultimately that uptrend will hold. This is the primary uptrend here that again has been in place all these months and months and months back to Q3 2011, as with Footsie. So that primary uptrend continues to be the basis of support for DAX, and I think that yeah, I think that should hold, and I think ultimately will be a decent buying opportunity for the DAX. But yeah, as I said, Footsie is in more, certainly is struggling more than the DAX is, but they're both not doing all that great. SP500. Oh dear, what's going on there? Oh no. Let's try that again. I think that's because I've selected that. .spx. Okay, SP500. Nicely forming support on that 21-day moving average. That seems to be a bit of a frequent theme over the past few months. That green line there, green moving average, nicely done. It's corrected back, looking to form support. Is this another buying opportunity? Well, if you look at the RSI, it loves that 60 point, doesn't it? It struggles to find above 60 in April and May, but since breaking above that, it consistently comes back to 60 and then pushes higher again. So that would suggest you're still in this nice strong uptrend. I haven't drawn the trend line in, but if I did, you can imagine it's going to be pretty good. It's not too bad at all. You're still in that trend, you'd say, and it looks like this is just another buying opportunity. So nice support area between that 1950 and 1968. Support coming in yesterday at 1959, so it's right in the middle of that band of support, and it's looking positive again. So in contrast to Footsie, which is back at its primary uptrend, the SP500 has got quite a significant way to go. That's 1906. It's still 60 points away from that uptrend, which is around about 3%. So that's interesting in itself as well. That SP500 has still got a 3% correction and still would be in its uptrend. So that suggests how strong the SP500 is compared to Footsie, certainly. Okay, that is pretty much it. I've covered quite a lot today, and I hope that you've been following it okay. What I will say is that, hold on, that you can email me. I've had some emails previously from people having wanting feedback, wanting further information about charting, and that please feel free to do so. I absolutely welcome your emails, and if you want to send them to marketing@HantecFX, then please feel free. My Twitter handle is @HantecRich. If you want to follow me on my daily analysis and daily commentary, please do so. Next webinar is trading with moving averages, and I think moving averages is a very underrated and interesting topic that perhaps you should, well, I would hope that you'd be able to attend, because it I think will assist you significantly with your trading. I think moving averages is a very useful topic. So the only thing I will also say is that after this webinar, we've got a quick survey that we're going to email around to you guys, and I hope that you can take a little bit of time. It's about 30 seconds. It's about 5 questions. Just to give us a bit of feedback in an attempt to hopefully improve your experience that you get with the webinars, and maybe get a bit of comments as well in terms of what's the future webinars that you might want to take part in. So that'll be hopefully a bit interesting for you. But anyway, here is the disclaimer once again, because I've been talking about live market information. You need to be reading this and make sure you've understood it. Just be careful. But other than that, I wish you good luck in your trading throughout the week, and I will see you in 2 weeks' time for trading with moving averages. So thank you very much, and goodbye.